for what at the time was PepsiCo's emerging brands unit. And it was really just, we were doing very little venturing at that point in time, but really operating some of the company's smaller, smaller tuck-in acquisition brands. So at the time it was Naked Juice and it was Izzy. And we had just acquired One Coconut Water. And as we'd done a bunch of diligence, but, didn't get down to a real granular level. And as I'm going through some of the bills that were coming into One Coconut Water after we had acquired it, there was this bill from Dirty Hands. They had no idea what the company was. And at the time, this is back in I believe it was 2012, maybe 2013, just had no awareness of Dirty Hands. And so I think I was set to just say, hey, let's turn this off. Whatever this Dirty Hands is doesn't seem to, it's not showing up anywhere. And I got a call from Will Ahern and let me know, hey, we're Dirty Hands. Understand, that you're questioning the charge. Are you going to be in New York anytime soon? Because at the time, Dirty Hands was just a merchandising unit for just Whole Foods in New York. Just a small handful of brands on their roster, one of which was One Coconut Water. And so I took the time to fly out and spend an afternoon with Will and Rory, and that's led to my immediate impression was, man, these guys have great relationships at store level, and the team members at Whole Foods around Manhattan really seemed to take to these guys' approach. It was a genuine approach, and I actually think that Dan, you doing these webinars and having a louder voice online on LinkedIn is very much on brand, not only with Dan Bubniak, but with Dirty Hands as well, in that, Will's always drilled this in, it's of service, and it's so genuine. It's such a genuine culture that, of service really makes sense. And I very much view what you're doing, Dan, here as of service, to be, sharing best practices, sharing thoughts, sharing communication, online. I think it's very much on brand, and I think it's appreciated out there in our ecosystem. I spent a long time with PepsiCo on the kind of bigger brands, mainly in sales management and strategy roles. My favorite experience was the one I just told you about, in terms of helping PepsiCo get up and running an emerging brands unit that eventually turned into a venturing unit for the company as well. It got me and opened my eyes to seeing all the great innovation and fun that entrepreneurs were having in an outside world. So I did decide to leave PepsiCo, and I went to Kavita, a brand that we had a lot of luck with and a lot of success with, and we're able to actually sell it to PepsiCo. And at that point, and it gave me the experience of obviously working for an entrepreneur directly. And just having the firsthand experience of living day to day in a fast-paced entrepreneurial environment where growth was quick, challenges and opportunities abound, and decision making processes are just a lot quicker. So it was a really good balance. And then as we sold the company to PepsiCo, instead of going back to PepsiCo, I'd met Bill Anderson, the founder of First Beverage, a couple of years before that, and he was really looking to continue to staff an investment team with operators on it to really be able to help our portfolio companies and where we made investments grow and offer the background that we had. And so I joined First Bev. This was back in the beginning of 2017, and have been there since, and working not just across our portfolio, but on new investment opportunities as well. And it's been a real pleasure to be part of the industry for an amount of time. So I've had a lot of big, a lot of small, and a lot of I guess small within big as well. So Dan, it's a pleasure to be here today.
Yeah, that was a great introduction. I think one of the things I've always admired about you, Bob, is your connection between sales, the industry, investment, and just being an objective operator, right? How do we connect the dots between strategy, cash, and operations? That's a lot of what we're about to talk about. So I'm just going to jump right into the meat of it here. And I think everybody's feeling some choppy economic waters right now. I'm hearing a lot of brands kind of questioning, hey, what's the future look like? How do we adjust to that, and how do we operate moving forward? So I think the first question, you've been through some boom bust cycles over the past 25 years. with recessions, with choppy waters, and all of these different scenarios. When you look at where we are today, how does the choppy waters affect kind of the industry? What's your expectation of that? And maybe you can give your perspective from the shopper, the retailer, and the brand. How does tough economic waters really affect those three stakeholders?
Yeah, I think the place to start is in general, food and beverage is resilient in recessionary times because it's essential, right? It's people still have to eat and drink. This is proved out, over time and through many economic cycles. This doesn't mean though that obviously consumer behavior doesn't change. It certainly does. Coming out of the recession in 2009, I remember reading a consumer segmentation piece that aptly labeled the most affected consumer group as the slam on the brakes consumer group. And of course, these are the folks that'll switch to lower cost, to private label, even for essentials. I think the good news is, for most premium emerging brands, which I'm making the assumption here based on the Dirty Hands roster and where we play, that many of the brands that have joined us today are premium emerging brands. The slam on the brakes consumer group probably isn't providing a significant portion of brands sales today. They're not leaning on that group heavily, so I'm not sure that I think that's actually probably one of the good pieces. I think in terms of consumer segmentation from there, and I forget how this article that I read many years ago was chopping it up, but I think what's important is that even if you were to make your way up to even the consumer group that really is unaffected by consumer downturn and it really buys consumables and buys essentials and buys everything as though we're pre-recessionary, non-recessionary times, it matters less because the impact and how they consume essentials is largely the same. The other major resiliency I think about, especially over the last couple downturns going back to 2009, and then even into the kind of turbulent short dip that we saw in 2020, is that the consumer drive towards better health and better wellness remains and is resilient. I think essential packaged goods are essential packaged goods are products that are central to consumers' well-being. So if you built a brand that is inherent in the brand, I think you're perfectly good off there. From a retail perspective, Dan, I've probably the closest I've come to having a firsthand experience was as a busboy in high school in retail, but I've certainly observed, and my perspective on retail is more from a consumer as well as a brand, right, or supplier operating in the industry for a long time. I don't know. I think about them as perhaps having the toughest because they're obviously that first point of where it's going to hit and the time to react to turbulent environments is shorter, simply because they're on the ground floor of where these consumer behavior shifts happen. And so when there's a government shutdown or higher authorities decide what we can and can't do going back to 2020, it's going to hit them harder. I do think like the two of the major influences in the current environment that are leading to decreased investment for brands is just the severe inflation and world events that have made it more expensive to operate a business in the current downturn. This is different than 2009 and even the turbulent events of 2020. Costs are at historic highs. Obviously, the hope here is that we're settling in, but we saw brands with beautiful gross margins last year, 60% margins, best in class margins that lost 15 or 20 points. And so I think while the expectation is certainly that there'll be a recovery of that this year, I think it's difficult to feel confident that you're going to get all the way back to bright, right? I don't think anyone. I think it's been a tough year to plan for. I think 23 has been a particularly tough year to plan for, for those that went through planning cycles in late 22. It's been a really tough planning cycle. I think the other thing is just the saturation of innovation in the marketplace relative to where consumers are. in their long-term journey towards, better wellness and better health. This has made it much more difficult to break through. And so it's just a more competitive environment out there. I think we've been through this 15-year, call it a golden period of not just food and beverage, but really consumer innovation in general being launched. And it's led to great choices and fragmentation in the consumer economy. But it's also made it just a higher degree of difficulty to really break through, and ultimately more expensive, right? And so I think this is another area where you really have to look at, do I have something that is truly differentiated in the marketplace, and that my messaging around that to consumers is truly breaking through.
Sure. And, as you look at the brands that you're helping today strategize for the next, let's say, year, what are you considering? How are you advising? I think, to your point, the industry is resilient. We know that, but there's still some tough waters ahead, I think, with the ability to fundraise and all of that. So how are you advising your brands on what you think the next 12 months is going to look like and how to navigate that?
Yeah, I mean, it's a really relevant topic in that even some of the biggest brands in our portfolio that have hundreds of millions of dollars in retail sales out there, we've had to remap to just a different endpoint, right? And for many brands, particularly on the earlier stage, that endpoint is self-sufficiency and making money to avoid having to bring in more capital. And so basically, how much do I have left to in order to get to the point where I'm making money? And that often leads to tougher choices. And so I think a lot of those choices are in high growth but subscale businesses. You've got to look at your cost structure and right sizing your cost structure around it's probably a tighter focus of where you can succeed. And so not every channel, not every brand, or not every channel, not every geography, not every customer is created equally. And so I think one good place to start there is really to look at customer, channel, geography level P&Ls and really understand it all the way down to the brand contribution level. So including route to market, including marketing costs, including service costs, right? In order to really understand what is my takeaway from different channels, different geographies, different accounts. And that ultimately then puts you in the position, then I think that's the starting point, and then to then be able to layer in other strategic questions that might even be longer term than that, on how you're going to win in the marketplace.
Sure. You mentioned a little bit about kind of narrowing the focus around looking at channels, looking at retailers, making some tough decisions. How should brands be thinking about innovation and maybe new opportunities that pop up right now?
Yeah, I think innovation is a really tough one at this time, right? Because I think you have to look at it as though you're starting a new business, right? Especially if you're talking about truly a adjacent piece of innovation that the company might be a different format, right? Versus just another flavor, or maybe even just another package, which I think could be highly relevant in certainly was in the 2020 downturn, right? I think about innovation in terms of multi-serve and multi-pack to better accommodate where consumers were at that point in time, which is home, and better pack sizes. Hard to do that and react at a speed that kind of maps to how long that's going to be necessary for. So you kind of have already had to probably have that in the works in order to really capitalize on that. But I think innovation is you really have to look at it as though, hey, I'm getting into new business, and the same way that you may have to resize the marketplace and where you're looking to go succeed versus where you're willing to just let go of for a while. I think it's the same sort of decision-making process where if you think the juice is worth the squeeze, go for it. But rarely do I see especially emerging smaller limited household penetration brands that can launch innovation efficiently in terms of people on the team's time just to get it launched, the cash cycles, right, of adding another set of inventory, right? It all kind of plays in. So I think you really have to think through that stuff and quantify it the best you can in terms of planning to know, is this where I want to make an investment? Because it's probably not going to be profitable right away.
Sure. And I think that's a good point in terms of how brands are rationalizing their capital, right? Where am I spending my money? And especially in an environment where it's tougher to predict when you can raise your next round, making sure it's going to your core drivers, I think is something that we've seen out there. We've seen a lot of conversation on. So, I guess, Bob, I want you to answer this question from two perspectives. First, as an investor, and then second, as an operator, right? So what metrics should brands be paying attention to? And I want you to come first from the investor perspective, because I think a lot of brands right now are trying to figure out, how do I raise money, and trying to put themselves in the shoes of an investor in terms of what are they looking at to kind of show that there's an opportunity. So how would you answer that as an investor?
Yeah, as an investor, I think, core metrics that help in making decisions, even as an investor, you want to see that we're looking at, right, are high level revenue, gross margin, profit metrics, cash conversion cycles, cash balance. I think all those are important. I think from a commercial perspective, from a commercial operation perspective, right, as an investor, all of the syndicated data, I think metrics are really important to know, especially within a competitive context, how that brand's performing. And so while, from an investment standpoint, cash is king, they say cash is king, velocity is king of, your retail health, right? And so, I think velocity and everything behind it as well. I mean, it's all of these metrics I'm citing, I think, are the important ones, but oftentimes the data that comes out of these metrics leads to other questions and going deeper into it. E-commerce, right, businesses, Dan, I think the two that I like the most to look at are return on ad spend and return on ad spend of net revenue, not gross revenue, because I see both, and obviously pricing matters. So looking at it as a percent of net revenue, I think, is important to knowing how efficiently that business is able to acquire and keep consumers. And then the LTV to CAC ratio, obviously also critically important there. I don't know that it's a whole lot different from a operator side, right? All of those metrics that I mentioned around, revenue, gross margin, profit metrics, cash conversion cycle is really important these days, especially for small brands, because that can have a big impact, especially if you're obviously rolling out to larger customers, and obviously cash balance. Any good operators keeping a close eye on those, regardless of the broader economic environment. I think what changes during a recession or during times like this is your financial strategy and the goals that you apply to those metrics. Sure,
absolutely. Now, I want to jump a little bit closer to trade spend. Another big question we get is, I think there's a gut reaction to cut trade spend when things get tough, and that's understandable. People need to have a runway here, but at the same time, you can really damage your top line and profitability if you do that too aggressively without thinking through what are the spends that are driving profit and sales versus what isn't. So how should brands be thinking about trade spend kind of going into this tough period?
Yeah, I mean, I think in a world of managing the budgets, like, fine to look at trade spend independently, fine to isolate it, right? It's obviously you see it always isolated on P&Ls, but I do think in terms of applying it at the account level, in terms of applying it to a channel level and in the business broadly, I think trade spend is best looked at in a broader context of, like, what is our investment into this channel, into this account, into this geography, inclusive of marketing, inclusive of any services you're providing, that you're supporting the business with, people, everything. And so looking at it that way, and all through the lens of, like, hey, how can I best drive trial and ultimately repeat, which feeds into the velocity metric I talked about earlier. And so, there's always a certain amount of price promotion they're going to have to do. But in addition to that, I think, sampling broader, marketing dollars, whether those are, event marketing or otherwise, services, right? Being in store, dirty hands, obviously, those type of merchandising, critically important. Paying for elevated shelf space and end caps, I think critically important too. But I think looking at it holistically within, and particularly in a time like this when capital is scarce, new fresh capital is scarce, and you've got to make dollars work. Putting it in a almost a zero budgeting exercise and building it from the ground up in a holistic way is a lot smarter than just saying, hey, we're going to try to manage to 13% trade spend this year.
Sure.
Maybe in some parts of the business that's 9% because you're gonna support it with other things, because that's just a better way to build trial and be successful in that account or that channel.
Sure. And I know every business is slightly different, but what are some of the line items or trade spend that you think is more important during a time like this? And what are some that you think is less important?
Yeah, I mean, I don't know that it's totally different in a recessionary time versus I hadn't really thought through that recessionary time versus a boom time or something in between. But I firmly believe that small, fast-growing, emerging brands with limited household penetration are always better directing whatever investment it is, people, money, promotional resources close to the point of sale, right? It's easy to get tempted by doing trying to do something with a celebrity, something that I would describe as like broader air cover marketing. But the reality is most brands don't have the penetration in any market. Maybe they've got a couple that stuff that's further away from the point of sale is really going to make sense, and you're really going to derive the ultimate the maximum benefit from it. And so I think the mindset just has to be like, you're much better off building around wherever folks can actually buy your product in store. The reality of food and beverages, it's still pretty limited in terms of what's bought online, especially with beverage specifically, which obviously is my specific expertise, but food and beverage in general. And I think that's one of the other things that I think has been a little surprising to folks coming out of the pandemic is that that kind of stair-step growth that we saw in percent of consumables and food and beverage specifically being bought online. The 5 to 10% jump that we saw that folks thought was really going to continue, not at that accelerated, but was going to continue, is really flattened out. And so it just speaks to the fact that, the dynamics of food and beverage are different than a lot of consumables. They're still being bought overwhelmingly in store versus online. And so I do think, you should really be thinking about it in terms of, hey, how do we support how do we support the investment dollars going right to the point of sale?
Yeah, I think it's, it also depends on people's cash situation, but I think spending money where you can quantify it and where your core customer is always kind of a smart move, especially when things are a little bit more uncertain. So we've had a lot of discussions with brands and on previous webinars about that specifically. It's like, don't throw Hail Marys right now when you might need that cash for a rainy day in the future.
Correct.
So Bob, one more question for you, and then we'll open it up for Q&A. So if people want to start dropping questions in the Q&A, feel free. Just broadly, what advice would you give to brands listening in about the next 12 months? What should they really be thinking about? Is there anything comes to mind for you?
Yeah, I don't think it's too dramatic to say that, for those without a line of sight to capital and maybe less of a runway, like survival is key, right? As I mentioned earlier, you have to tighten the focus and cost structure. I think showing success in a tighter footprint is much more preferable and much more efficient, more importantly, right? with mixed versus showing, broad success with mixed results or probably even subpar results. I think that's always true, but I think, especially if you're thinking about it in terms of like, hey, how am I going to get to the point where I can raise capital? I know, personally, I would much rather see an approach and, be able to be in a position to just better assess a business if they've, made hard decisions to, either let go of or not expand into other places because they didn't have a lot of the fuel to go do that, the capital to go do that, and rather focus on just a smaller footprint and do that really well and be able to show, hey, this success that can be replicated elsewhere with the right capital.
That's awesome. Cool. So we're going to jump into the Q&A. We got some questions rolling in here. So the first question is, what's the typical amount of time it takes to stage a round of capital raising?
Yeah, I think 6 months is a good target point, and probably baking in up to a year, but probably realistically baking in 9 months to raise a round of capital. I think it was one of the unfortunate things for entrepreneurs is, right, that they have to be doing this while they're trying to run a business, but that's generally what it takes. From a first bev standpoint, we never like having first conversations with businesses and entrepreneurs and management teams when the time is actually the raise. We much rather get to know folks earlier on, perhaps when they're not even raising capital, and be able to follow the story and build a relationship along the way. And I don't think we're unique in that way, but I think it's certainly worth mentioning.
Is there anything, any brands, any sectors or categories that you guys are really kind of looking forward to in the future, either you personally or the industry, or sorry, First Beverage?
Yeah, I think there are a lot that we like, it's hard to ignore especially since we're not in it today, it's hard to ignore the long-term trend that has been there with energy drinks, right? And the growth that is continued to sustain there, and we don't see that really slowing down anytime soon. We are in coffee, but we continue to love coffee as well. I think on the alc side of the business, like we continue to love spirits, and not necessarily. I think we're paying astute attention, obviously, to the low and no alc portion of it, but we continue to like spirits as well. I think one of the things the last few years has shifted us a little bit on is looking at categories that maybe have been ignored, or where share has been taken from for a number of years now. But beer will be around forever, right? And so beer is certainly a place that's interesting to be looking at right now. Given it's been a down market for a lot of beer with a lot of innovation around it that has taken share away from it, but continues to be a segment that's going to be there. So I think we've got a lot of things that we continue to like. I think that where we remain really encouraged is by the continued fragmentation of the consumer economy. The continued, trajectory that American consumers are on toward wellness, and what that means for, innovation out there.
Yeah, I mean, I really think, and this is probably a bias, but I think we're at the beginning still phases of natural food. I think with COVID and coming out of people who were hyper focused on their health and realized the effects of health, you couple that with social media and the access to information, I think we're at the beginning phases of natural food really accelerating into the future. So irregardless of the short term here, I personally think there's a really bright future for the industry.
Yeah, I agree with you, Dan. I think the past 10, 15 years, where there's been a lot of innovation launch, I think it probably has been as much about the absence of things, so the absence of sugar and calories, as it has been about better ingredients and adding functional ingredients to things or to products. And so I think there's still a lot of room, particularly on the latter, right? I think there's always going to be room on reduction of sugar, reduction of calories. But I think the latter, which is actually kind of this idea of food as medicine, which has been around for a long time, but really has not. I don't think we've seen even the beginnings of it yet. I think there's a lot to come there, and I think that's exactly what I'm getting at. Case in point, of why we're excited.
Yeah, and I just love good tasting products, right? Like throw fat in there, throw some natural, sweetener in there, but it's got to taste good. You know what I mean? I think there's a lot of room to grow there.
For sure.
So another question here, is there any specific flags that you see when you guys are raising money in companies or founders, things to watch out for?
Yeah, I mean, I think in general, you want to see a real care and passion for everything about the business, from how the brand has been stewarded from day one as a founder, how capital has been spent to date. I think is important. I think history can be a really good indicator of the future, right? And so you want folks, particularly in the current environment, to have a real orientation towards how can I eventually make money, and if this were the last round of capital I was going to raise, do I have optionality there? Like, am I within striking distance of building a real sustainable business? I mean, there's generally in the history of our short history as a firm, short history as a firm, I mean, we've for the most part invested in an early stage, and so there's limited data to go on, but I think I do think there's enough there that even in early friends and family, maybe even some venture capital money, like you can tell how well folks have taken care of like the money that's been brought in to date.
Right. Absolutely. Yeah. We were speaking to David a couple of weeks ago on a webinar, and he had said, is the person going to be a good steward of capital? And I thought that was well said. Like, have they proven that the dollars coming in are going to be spent? Do they know where they're going to spend it? And are they going to be treat it like it's their money? Right. And I thought that was really well said.
I like that.
Yeah. So, another question here, this is kind of not about the rough times, but you've been successful in a sales leadership role at multiple brands, big and small. What is the secret to running an effective sales organization at a brand?
I mean, the first thought that comes to mind is just like, you really have to love what you do. You have to love the people you're doing it with. Like, it just makes it so much easier. And these are day in, day out, high touch, high communication jobs. And so you can't fake that, right? It gets seen through pretty quickly. I think as a for sales function specifically, I think one of the things that really separates the good salespeople from the great is really being able to take a general manager mindset, have general curiosity and general interest in what's going on in the broader business, not only because it can help you, right? And any customer that you're going to walk into, you're going to be better suited being able to speak to the entire operation really, really well and really, really thoroughly than if you're not. I think that always translates well too in customer situations and in front of customers. But I really think having, whether or not you want to be a CEO someday, or whether or not you want to be go into another function, even if you're you love sales, you love being in front of customers, you love bringing in wins and being a rainmaker, even if that's your mindset, I think adapting a general manager mindset is always rewarded, both at the customer level and obviously especially internally within leadership teams as well.
Sure. And to drill down on that a little bit more specifically on choosing channels, right? Like your job in sales is to figure out what is the right go-to-market strategy. How do you approach that?
Yeah, I think assuming we're talking about, I think about Kavita, in that context, right? And I think a lot of brands have followed the same path, which has been, successful, continues to be successful, which is, really finding your core consumers and your low hanging fruit consumers, which, tends to be for products like that in the natural channel, in Whole Foods and Sprouts and the independent world, and building out from there. And not trying to accelerate a trajectory that may not be there, right? Because it's probably going to be more expensive if you go from being in the natural channel to trying to open up C-store the next year, right? I think you're perhaps missing the opportunity to build the next layer of consumer and the next layer of consumer before before maybe the C-store, the typical C-store consumer is there for your product. And so sequencing it properly, and it's not necessarily, Dan, just by channel, right? I think geography becomes important. And if, particularly if you're taking a DSD route to market and have, food service available to you because of, your route to market, really supporting, your retail distribution with food service distribution as well, because, early on, it really is all about, building trial and having it available for folks to try. And so the sequencing becomes really important as well. And I don't think there's any, one formula to the sequence, but I do think there's there's certainly logical, decisions there that, that can be made just based on, learning, knowing who your close-in tribe of consumers is and really building out from there.
Yeah, and I think just also looking at your financial situation and then understanding what a move into various channels or geography is going to do to that, right? Like I think so, people just want to get out there and sell, which is great. I mean, that's what we do, right? That's what founders and entrepreneurs are best at, but not understanding the reality of how that's going to affect your bottom line and your cash position, I think is where people get in trouble. So I think knowing the numbers is important as well and calculating kind of where to go, right? And how that's going to affect your business.
Like, absolutely. In fact, I feel like I'm seeing more and more strategy, like, company level strategies now with not just, hey, here's what we are going to do and here's where our priorities and focus are going to be, but also like the corollaries of what we're not going to do, right? And what we're, deliberately saying that. And I think it's smart, right? Because there is such a, especially within sales organizations, there's such a gravity toward expansion and more outlets and, more growth, right? But the reality is, like, a lot of that'll be one time, or you won't be successful, or it'll, won't be efficient from a cost standpoint, if it's not timed at the right stage. And so, declaring, for a 1 year, strategy that, hey, we're not going to go international, or we're not going to go to Canada, even though it's being offered and that the call is incoming, to want it, or, we're not going to go to, we're a California-based company and we're not going to go to, Florida this year. I think those are important as well. And I'm seeing more and more of those baked into strategies of not just what are we going to do, but here's what we're not going to focus on as well, just to be clear.
Yeah, I love when I hear that, to be honest, because it shows that there's real kind of conviction around the decision making and thoughtfulness around, how they're allocating their capital. So I do genuinely love when people say that.
Yeah, and you think about, by the way, you think about entrepreneurs, Dan, as well, and like they're eternal optimists, right? And so it almost becomes more important earlier on to have those corollaries to your core strategy of what we're not going to do, because I think putting on a paper just sets entrepreneurs up to be, maybe to have a chance of being more disciplined of actually not doing it, right? Because the temptation is huge.
Sure. So last question for you here. This is a bit more tactical. I think there's a lot of pricing pressures going on in the market in terms of brands adjusting price to capture some of their price increases, but not necessarily hurting their consumer or affecting volume. Like how have you approached that with kind of the brands you're working with?
It's a little bit of trial and error, frankly. I mean, I think in some of our portfolio companies, we've been frankly wrong on the amount of pricing we thought we could get. And let me be clear, like I don't think what a lot of the stuff I read about about manufacturers taking pricing, beyond what their cost increases have been, like, I don't buy into having, at least not seeing it firsthand in our portfolio companies. We're not covering our cost of increases, or in some cases maybe we barely are. So it's not like we're doing it out of opportunistic, trying to gain on margin. We're just trying to get back, right, what's been passed on to us. And so in a way, I think that's maybe driven the wrong decision making, because we're trying to recapture as much as possible without maybe having fully looked into ahead of time what a 10% price increase might mean. And by the way, how that might show up on shelf, because we're not the only ones, manufacturers aren't the only ones taking out cost increases, retailers are as well. And so just because we're taking 10% doesn't mean that's not going to get added onto and margined up by retailers as well, right? So carefully planning that through and knowing where a 5 or 10% price increase to a distributor or manufacturer is actually going to translate through on shelf, I think is important, to really know and understand and be eyes wide open on. But I think to the extent that you've promoted or come down before over time, looking at those metrics, looking at the competitive metrics, I think all is important. But at the end of the day, I do think there's a little bit of trial and error in this, in that we thought that we had we had good conviction around the ability to take pricing in one of our portfolio companies, and the data is still coming in because we did it late last year, but it appears that it's mixed at best, and maybe not what's best for the long term of the business.
Yeah. And it's been interesting out there in the market. The retail sales report, and this is all retail sales, but came back up 3% in January, where people were expecting it to be down. So there's been a lot of price adjustments and prices going up, but yet we're still seeing people spending money at the shelf, which is
right.
So cool. That's going to be the last question here, guys. I appreciate everybody's time. Thank you again for the patience in the beginning. Bob, we figured it out. We have another webinar in 2 weeks with Laura Troiano, who's the SVP of Sales at Mush and formerly at RX Bar. So she's going to chat with us about scaling sales teams.